If you spend $20,000 fixing up your home this year, the government will hand you $3,000 back. That is not a typo and it is not a scam. But here is the part that stops me every time I say it out loud. Most of the seniors watching this channel right now will never see a dollar of it. And it is not because they don't qualify. It is because nobody ever told them the credit exists. Or worse, someone told them half the story and let them walk into a renovation expecting money that was never coming their way. I'm going to fix that today. By the end of this video, you will know the exact line on your tax return where this credit lives, what kind of home projects actually count, how you may be able to claim the same receipt twice under 2 different programs, and the one group of seniors this credit pays absolutely nothing to. If you are on old age security and the guaranteed income supplement, that last part matters more than anything else in this video, so please stay with me until we get there. Quick note before we start, for those of you who found me through my videos on the Canada Pension Plan, or CPP, and Old Age Security, or OAS. This particular credit doesn't come from Service Canada, the government office that runs your CPP and OAS payments. It comes from the Canada Revenue Agency, or CRA, the department that handles your income tax. Different office, different rules, but just as real and just as often overlooked. Let's start with what this actually is. It's called the Home Accessibility Tax Credit, and on your tax return it shows up at line 31285. The math behind it is simple, which is rare for anything involving taxes. You can claim eligible home renovation expenses of up to $20,000 in a single year. The credit gives you back 15% of whatever you claim. 15% of $20,000 is $3,000. That's your maximum, once per year, for work done on the home you actually live in. Now, who is this for? There are 2 ways in. The first is simply your age. If you turn 65 by the end of the tax year, you qualify, full stop. No doctor's note, no application to prove you need a grab bar. You just need to be 65 and own or live in the home. The second way in is the disability tax credit, a separate CRA credit for people with a lasting impairment. If you already qualify for that one, this renovation credit opens up to you at any age, even in your 50s. And here's something a lot of families don't realize. If you have a parent living with you, the renovation can qualify even if you are the one paying for it and your parent is the one who is 65. The law follows the person the work is for, not just the person signing the check. Let me introduce you to Doreen. Doreen is 68, lives in Kelowna, and has been widowed for 4 years. She gets by on OAS and the GIS, the Guaranteed Income Supplement, which is a top-up payment for seniors with low income. Her knees aren't what they used to be, and last winter she slipped getting into her tub. Her son wants to put in a walk-in shower, and Doreen keeps saying no because she assumes it's a luxury she can't justify. What Doreen doesn't know yet is that this exact project is precisely what this credit was built for. We'll come back to Doreen in a moment because her situation is going to teach us the most important lesson in this video. So what actually counts as eligible work? Most people hear accessibility renovation and picture a wheelchair ramp, and yes, ramps count. But the definition is much wider than that, and this is where a lot of unclaimed money is hiding. The test the CRA applies is whether the work helps a person get around the home more safely, function more independently, or reduces the risk of injury, and whether it's a permanent part of the house rather than something portable. Under that test, you're looking at walk-in bathtubs and curbless showers, grab bars and stair railings, widened doorways, non-slip flooring, stair lifts, better lighting on staircases, liver-style door handles instead of round knobs, which matters enormously if you have arthritis, and lowered kitchen counters that can be reached from a seated position. What doesn't count is anything cosmetic or purely about resale value. A new roof because the old one leaks, fresh paint, a backyard patio, new appliances. None of that qualifies even if it happens during the same renovation. Here is where it gets genuinely interesting and where I want you to lean in a little. Alongside this credit sits a much older one called the Medical Expense Tax Credit, or METC. Ordinarily, tax rules don't let you claim the same dollar twice, but these 2 credits are a specific exception. If a renovation was done for a medical reason, such as a shower modified because someone can no longer safely manage a bathtub, that same expense can, in the right circumstances, be claimed under both the Home Accessibility Tax Credit and the Medical Expense Tax Credit in the same year. I'm not going to tell you exactly what that adds up to for your household because the medical credit depends on your net income and everything else you've claimed that year, and that calculation genuinely belongs to an accountant, not a video. What I will tell you is this: ask the question. When you sit down with whoever prepares your return, ask them directly, can this renovation be claimed under both line 31285 and my medical expenses? That single sentence has, in my 30 years of doing this work, put real money back into the pockets of people who had no idea it was available. Now, the part I promised you at the start and the reason I mentioned Doreen, This credit is non-refundable. That word matters more than almost anything else in this video, so let me explain it properly. A non-refundable credit can only reduce tax you already owe. It cannot create a payment for you. If your total tax bill for the year is, say, $800 and you qualify for the full $3,000 credit, the credit wipes out your $800 and the remaining $2,200 simply disappears. It is not carried forward to next year. It is not deposited into your account. And if you owe no federal income tax at all, the credit is worth precisely $0 to you. This is where Doreen's situation matters. A senior living mainly on OAS and the GIS very often pays little to no federal income tax because those income levels sit below what gets taxed, which means the very person this credit was designed to help, someone in exactly Doreen's position, is often the person it helps least. That is not a criticism of Doreen, and it isn't a flaw in her planning. It's simply how a non-refundable credit behaves. And I would rather you hear it plainly from me now than discover it after the invoice arrives. So if that describes you, what do you actually do? 3 things in this order. First, before you sign a contract with anyone, find out whether you owe federal tax at all this year. Look at your most recent notice of assessment, the summary CRA sends after you file, or ask whoever does your return. That single fact tells you whether this particular credit belongs in your plan or not. Second, look at a different federal credit called the Multi-Generational Home Renovation Tax Credit. On line 45355. Unlike this one, it is refundable, meaning it pays out even if you owe no tax. It's built specifically for creating a self-contained secondary suite. For instance, if a parent is moving in with family, and it covers 15% of costs up to $50,000 for a maximum refund of $7,500. It won't help with a simple bathroom renovation, so be honest with yourself about whether your project fits. But for the right situation, it is worth far more than the credit we've spent most of this video on. Third, call your municipality. Many cities and regions run grant or forgivable loan programs for lower-income seniors doing accessibility work, entirely separate from the tax system, and they are often the best option of all for someone in Doreen's exact position. Before you spend a single dollar on any of this, 3 habits will protect you. Get a proper invoice from your contractor with their business name, address, and GST or HST number, not a handwritten total. Ask them to itemize the accessibility work separately from anything cosmetic done at the same time, so a walk-in shower is listed apart from tiles you simply like the look of. And pay in a way that leaves a paper trail. A credit you can't document with a proper receipt is a credit the CRA can, and sometimes will, deny. If you take one thing from this video, take this. This credit is real, it's worth up to $3,000, and it applies to more everyday renovations than people assume, from a walk-in shower to a widened front door. But it only helps you if you actually owe federal tax, so check that first, before the work begins, not after. I'm going to keep doing exactly this every week, taking one thing the CRA or Service Canada offers seniors, and explaining it in plain language. No jargon, no selling. If that's useful to you, hit subscribe so you don't miss the next one, where I'm going to walk through exactly when it makes sense to start your CPP early at 60, wait until 65, or delay all the way to 70, and what that decision actually costs or earns you over a lifetime. Tell me in the comments what you've been putting off around your own home, and whether you already knew about line 31285. You've spent your whole working life paying into this system. You've more than earned the right to understand exactly what it owes you back.